Hello everyone and welcome back to our yet another discussion on the consolidated financial statements. In this particular video, I'm going to talk about the consolidation of the statement of financial position for a parent with one subsidiary. This video follows my other video that handles the presentation procedures under IFRS 10. So it means that you as a student watching this video, you need to watch the two videos concurrently. You start with my video that handles the consolidation procedures under IFRS 10 and follow that with this video that handles the consolidation of head group. Now, for the interest of time and to shorten the video, make sure you have read through all the parts of this question, because I'm going to be referring to the different parts of the question as if they have been clearly read. But briefly, in this question, we are told that the parent head company secured a majority equity shareholding in food company on 1st of January 2017 by making an immediate payment of 5 shillings per share. The summarized statements of financial position of the two companies as of 31st of December 2017 are presented as below. I don't know the time you're watching this video, but we are using 2017 as our financial year. Now, if you're watching from our YouTube channel, make sure you subscribe to our YouTube channel. We are on our journey to 10,000 subscribers. So this video is provided to you for free. So in return, make sure you subscribe to our YouTube channel so that we can give you the best videos on the same subject. And of course, don't forget to like, share, and comment. The comments help us in improving our videos on our YouTube channel. So back to our question. We have several other additional information that is given, which I believe you have read through. My assumption is that by the time you're doing this video or you're running this video, you have already read through the additional information. As you can see on the screen, we have the format already laid out, and that is the biggest advantage of these kind of questions, because we already have the statement of head company and the single statement of food company. So when we are preparing our consolidated statement for the two companies, we follow the format laid down under the single company. So as you can see here, we have the non-current assets, including property, plant and equipment, intangible assets, investments, inventories, trade receivables, bank, etc. Under the, of course, we are required here by the examiner to prepare the consolidated statement of financial position for head group of companies as of 31st of December 2017. All right, now let us jump into our solution. Okay, so as I'm sharing my screen with you, you can go ahead and hit that subscription button, okay, so that each time we produce a video, you are notified. Don't forget to turn on the notification bell. On my screen is our template or our format that we are going to use. And as usual, I begin with head group of companies, consolidated statement of financial position. Don't forget, consolidated statement as of 31st of December 2015. 17. So ideally, the first thing you do is to lay down your statement so that you can begin tasseling out the notes or the workings. So as you have seen from our question side by side, I want you to take this video as you look at the question. Preferably, you would print out the question so that this becomes easy for you. So we have the non-current assets, which include property, plant and equipment. We have goodwill. Of course, I'm going to explain that. I can even put it in red, why the goodwill there. And then, of course, we have other intangible assets. From there, we move to the current assets. Inventories, okay, we shall do workings for property, plant and equipment. We shall have a working for goodwill. We shall have a working for the other intangibles. We shall have a working for inventory. And below inventory, we have the trade receivables, shall have a working there. And of course, for the bank, we shall not need a working because according to our question, food company had an overdraft. So they didn't have a positive bank balance. It is only head company, the parent, which had a positive balance. So I will not go into those workings. I will take the 3,400, which was the bank balance of head group, straight to our statement. And then below that, I have my total assets. Okay. And of course, you know, our full statement of financial position has the second part or component, which is equity and liabilities. And under that, I have the equity shares of 1 shilling each. I have the retained earnings. Then I have the non-controlling interest there coming in. Then we have our total equity. Okay. And then, of course, below that, I bring in the liabilities. And of course, for purposes of the workings, shall have a working for the retained earnings, which is our note number 7 there. Then the non-controlling interest, we shall also need a working there. Then, of course, under the liabilities, we have non-current liabilities, including deferred. Now, the deferred tax is a long-term liability. This one we shall not do a working for this because we didn't have any major adjustments. So I will simply add the deferred tax of head company to the deferred tax of food company, and that brings me to a figure of 33,000. So, or 33 million to try and cater for the other 3 zeros. Then, of course, the current liabilities, we have the bank overdraft. Food company, I mentioned earlier that food company didn't have a positive balance. Instead, they had a negative balance, which is the overdraft, which is an overdraft of 2,500 there. Then, of course, we had our trade payables, which I've included the working, try and explain the way the figure was arrived at. So at the end of the day, we shall have our total equity and liabilities. Now, when you look at my format, it is exactly the same format with a few adjustments for the investment in food company as per our consolidation procedures under IFRS 10. Say that this one is cancelled and replaced with goodwill. The goodwill is calculated in accordance with IFRS 3 business combinations. Again, if you have not yet watched the video on business combinations goodwill calculation, I request that you go back to our YouTube channel or your student account. If you're watching this from the student account and you have enrolled for the financial reporting course, just go back to your student account. You'll be able to see that discussion where we calculate the goodwill. So the layout has been done following our format here. There are no changes, no big changes I have done. That is exactly what you're going to do in the exam. All right. So as I mentioned, under the consolidation procedures, your note number 1 is the group structure. In the examination, you might not be told to present the group structure. Take it from me that the group structure is a silent requirement for this particular question. So do not do anything before presenting your note number 1, which is the group structure. So if you have read through the question clearly, you would appreciate the fact that head company is our parent or the acquirer, food company is the subsidiary, the acquiree. The acquisition date is 1st of January 2017. You indicate it here. Then you show the percentage of control in a working if it's not given outrightly, and then the NCI, which I've indicated here that the NCI is the non-controlling interest. So the percentage of control being 75% and the NCI being 25%, that gives us 100%. But how do we get the 75%? In my working one on the following slide, you see that I bring out the percentage of control. So the percentage of control is simply the number of shares held by the parent, in this case head company, over the number of shares in food company. The number of shares held by head company out of the total number of shares in the subsidiary, which is our food company. That is expressed in percentage terms. Now when you look at our question here, under investment, I want you to focus right here, under investment. Sorry about that. So under investment in food company, we have an indication that our investment is to the tune of 7.5 million shares in food company. Each share is valued or quoted at 5 shillings per share. So if I do the math, just get your calculator, you can pause the video, multiply 7.5 times 5, you'll see that we come to a figure of 37.5 million. And that is the worth of our investment. So if head company is holding 7.5 million shares, how many shares have been issued by food company? That question can only be answered by looking at the column of food company, our subsidiary, going or moving down to the equity section, and here you see that the total equity is of 10 million shillings, considering the 3 zeros that have been provided for as the level of precision. So if we have total equity of 10 million and each share has a nominal value of 1 shilling, it means outrightly that in total you have 10 million shares in issue. And out of the 10 million shares in issue, head company, the parent, has 7.5. So you do the math. And of course, coming back to our slide here, you will see that the 7.5 million has been provided here in our computation as the numerator over the 10 million shares, which are the shares that are in issue, or the shares issued by food company, our subsidiary. My math shows that this fraction is 75%, meaning that the controlling interest is 75%. From the discussion we've had under IFRS 3, IFRS 10, we have appreciated the fact that where the parent has more than 50% of the ordinary share capital, the parent outrightly controls that subsidiary. And from IFRS 10, we are supposed to consolidate all those subsidiaries where the parent has ultimate control, more than 50%. So that is our note number 1, and you're expected by the examiner to present your note number 1. You can now take a break, pause the video, and put down this entire working. Don't forget, we had this framework drawn before, and then of course we have this calculation that has been done. Next, we move to our note number 2, where we consolidate the property, plant and equipment. I presume that right now as you're doing the notes, your structure or your framework is already prepared. So to the notes, we shall follow the consolidation procedures, and according to the consolidation procedures, we are supposed to add the property, plant and equipment of the parent head company, which is 55 million, to that of the subsidiary, which is 31 million. However, from IFRS 3, the measurement principle or rule, we are required to use the additional information to adjust the book value for the PPE or food company to its fair value. The 31 million that you see here is actually the book value. Yet the consolidation procedures require that we use fair values, IFRS 3. So what are you going to do? We shall go back to our question, and for avoidance of doubt, you can see that my 55 is right here and my 31 is right here. But for the purposes of valuation of the assets, liabilities assumed for the subsidiary, we need to use the fair value. 31,000 being, or 31 million being our book value, we have been given additional information in Roman 2 in regard to fair values. And according to our Roman 2, we are told that at the date of acquisition, the fair value of food company's property, plant and equipment was equal to its carrying amount, with the exception of a plant, which had a fair value of 5 million above its carrying amount. At the date, the plant had a remaining life of 5 years. Food company uses straight line depreciation for plant, assuming nil residual value. All this information is key to determining the fair value of our PPE in food company. So what are they saying? They are saying that the 31 million you're seeing right here is way below the fair value by a figure of 5 million. So for you to arrive at the fair value, you need to add the 5 million to the 31 million in the financial statements, in the books, so that it comes to a figure which reflects the fair value. However, this was done at the date of acquisition, yet we are consolidating at 31st of December. So how many months have passed? Ask yourself, how many months have passed? Definitely a full year has passed since acquisition took place on 1st of January 2017. So this 5 million, being a fair value adjustment, needs to be depreciated to reflect its carrying value, because right now we are consolidating on 31st of December 2017. Acquisition happened on 1st of January 2017. So putting all that into consideration, we are going to introduce the fair value adjustment of 5 million to our note number 2, PPE, and then we depreciate it over the 5 years. We are told in Roman 2 additional information that food company uses straight line over 5 years for this plant. So 5 million divided by 5 outrightly, that gives me a 1 million additional or excess depreciation. At the end of the day, we get our group PPE as 90 million. So I'm going to transfer this 90 million to our statement. And as I transfer this, please don't forget to subscribe to our channel so that you can watch all the videos. If you're watching from the student account, after this, go straight to our YouTube channel and subscribe. So property, plant and equipment, we have our 90 million right there. I've transferred it from note number 2. Next is our goodwill, which is in note number 3. Remember, in the place of goodwill, we had the investment in food company, this one right here. So this is the figure that is cancelled out, and of course it is cancelled out together with the equity of food company, as you are going to see ahead. So ultimately, what I'm going to be doing under note number 3 is the cancellation process. We have already done the goodwill computation. If it is your first time you're seeing this, make sure you go back to your student account or to our YouTube channel and run that video where I teach the goodwill calculation under IFRS 3. Taking you to our notes, we have our goodwill. So according to our previous discussion on goodwill, we begin by recognizing the fair value of the consolidation transferred, which we have seen is 37,500 million. This is the money that was paid by head company to acquire the 7.5 million shares in food company. To that we add the non-controlling interest, the NCI, and of course you know that the NCI are the other people or the other stakeholders that are investing in food company together with you. Since the parent paid 37.5 million, that makes 75%. What about the 25%? So the entire investment is 100% and the 25% is owned by the non-controlling interest. So where do I get the figure for the non-controlling interest? The answer is simple. Go to the additional information. So for exam purposes, you always get that information from the additional information given by the examiner. And according to what we have here, we see that head's policy is to value the non-controlling interest at fair value at the date of acquisition. And for this purpose, the directors of head company consider the share price of food company at 4 shillings per share to be appropriate. Now that we know that the parent has a total of 7.5 million, the total number of shares are 10 million, meaning that the difference is 2.5 million. Of course, you know 2.5 plus 7.5, you get 10 million. So the non-controlling interest, the NCI, is holding the remaining 2.5 million shares. And according to our Roman 1, we are told that 2.5 million, each share is valued at 4 shillings. So we do the math, 4 shillings times 2.5, that is automatically a 10 million. So I come back to my computation schedule here, note number 3, and I bring my 10 million. And of course, I have to show how I get the 10 million. I will show the examiner that I have the 2.5 million times the 4 shillings, and that comes to 10 million. At the end of the day, we get our non-controlling interest coming to 7.5 million. So at the end of the day, we shall compare this total investment, the 25 and the 75%, with the net worth or the fair value of identifiable assets acquired and liabilities assumed. Friends, you should recall that when an investment is being made, the investment is made in the equity of an entity. So I'll proceed to recognize the ordinary share capital, which is 10 million. So we have to recognize the ordinary share capital for that matter, and then we bring in the pre-acquisition. Please don't forget the pre-acquisition retained earnings. So where do you get the pre-acquisition retained earnings? And what are pre-acquisition retained earnings? These are some of the things we discussed under IFRS 3. But I'll still remind you, pre-acquisition retained earnings is the accumulated profit that was earned by the subsidiary before you took over the subsidiary. So the pre-acquisition retained earnings will form part of the net assets when we are determining goodwill. And according to our statement of financial position, the pre-acquisition retained earnings are the retained earnings at the date of acquisition, which is our, I'm focusing on food, which is our 12,000 right there. So I bring my 12,000 right here. And now that I've considered the ordinary share capital and the pre-acquisition retained earnings, I now bring in the fair value adjustments. One of the fair value adjustments that we have seen is the fair value adjustment on the plant, which was 5 million. We also have another fair value adjustment, which is on the customer relationships, intangibles that we are yet to see ahead. So I'm going to put it here, but don't forget, I'm going to explain this in our other intangibles. So there's a 4 million, 5 million, and the pre-acquisition ordinary share capital, which comes to 31 million. At the end of the day, I have my goodwill as at the date of acquisition, which is 16,500,000, which is the difference between the total investment and the net assets. So 31 million minus 47.5, outrightly we get 16,500,000. Now, what do you know about goodwill from IFRS, from IAS 38 and also IAS 36? Goodwill must be tested for impairment. Since we are looking for goodwill at the reporting date, 31st December 2017, which is our reporting date, we have to test that goodwill for impairment because some time has passed. So in the exam, you need to be sharp enough to look for the goodwill impairment information. Looking at our additional information number 5, you see that impairment tests were carried out on 31st of December 2017, and this concluded that the consolidated goodwill was not impaired. So in those circumstances, goodwill impairment is, so I come back here and include my 0 there, and therefore the goodwill at reporting date 31st of December 2017 is 16,500,000. I then bring my goodwill 16,500,000. Next we move to other intangibles, which is our note number 4. As you have done before, again following the consolidation procedures under IFRS 10, we proceed to consolidate our intangible assets. These will include the intangible assets for head company, which is 7,500, food company, which didn't have any. However, when we look at our question, here, you see that food company did not have intangible assets. There's nothing. Okay, did not have intangible assets. There is totally nothing. However, it is not nothing at all. When you go down to the additional information, which is additional information number 3, Roman 3, we are told that at the date of acquisition, head company valued food company's customer relationships as a customer base intangible asset at fair value of 4 million. So this means that whereas the book value is nil, the fair value is 4 million. Food company has not accounted for this asset, and that's why we have a 0 there. Trading relationships with food company's customers last on average for 8 years. So this information has been given to you to help you amortize that intangible asset. And coming back to our note number 4, I bring in the intangible assets for food company. I'll bring that. These are the customer relationships, which is our 4 million. That 4 million was determined on 1st of January 2017. However, we are consolidating on 31st of December 2017. A year has passed. So that 4 million must be amortized over 8 years. And what is the 8? Where do I get the 8? The 8 is the period over which the customer relationships last. So we amortize over 8 years, and that comes to our 500, and that comes to our 500,000, considering the 3 zeros up there. At the end of the day, the consolidated or the group intangible assets come to 11 million. I carry this 11 million to my statement to include it among the non-current assets. So thank you for watching this first segment of our consolidated statement of financial position. Don't forget to subscribe, hit the notification bell, comment, like, share. In our next segment, which is our part 2, I'm going to show you how we consolidate the current assets. I'm going to show you how we consolidate the current assets. I have split this video into 4 main segments so that I can clearly explain to you and you understand how we prepare our consolidated statement of financial position. I wish you all the best. See you in the next segment, in the next part, in the next session of our video. Thank you.